Today we are going to cover goodwill calculation and also cover consolidated statement of profit or loss. I suggest before you watch this video that you go to the ACCA website and download this question paper that I'm showing here for financial reporting FR, or formerly called F7, for March-June 2021 exam. Together today we'll do question 2 on this question paper. So I suggest you go ahead, download this question paper and also read the scenario as well as the requirements of this question paper, as I will be referring to it a lot. Now let's go to the scenario. This is scenario 2. Now let's go to the requirements. The first requirement saying calculate the goodwill arising on the acquisition of Silver Co. B. Prepare the consolidated statement of profit or loss for Gold Co. for the year ended 30 September 20x2. So let's go to the scenario. If you haven't read the scenario, pause the video and read the scenario on the question paper that you have already downloaded. Now, when calculating goodwill, we have to know the group structure and also we have to know the net assets at acquisition. These are the standard workings when doing consolidated financial statements. Now, let's go to the workings. Working number 1 is the group structure, where gold is the parent, has 90%, then the NCI have 10%. Now let's go to the next working, which is net assets of Silver Co. Silver Co being the subsidiary. We want the net assets at acquisition. We also want the net assets at reporting. Now we have got the share capital. Of 16 million. I am working everything in thousands, so I'll say 16,000. We have got the retained earnings. Let's go where the retained earnings are. In note number 1, we are given the retained earnings at the beginning of the year, 1 October 20x1. Our year end in 30 September 20x2. So this is the beginning of the year. So those retained earnings, 56 million. I'm working in thousands, 56 million like that. Then we have got the profit for the year that we need to split between acquisition and the reporting. So at reporting, the profit for the year is 9,920. Then at acquisition, the date of acquisition is 1 January. But the year starts in October. So we have got October, November, December. We have got 3 months pre-acquisition and 9 months post-acquisition. So let's split that. 3 months pre-acquisition, would multiply that figure by 3 over 12 like that. So 3 months pre-acquisition profits is 2,480. Then we will have the fair values. The fair values are given in note number 2 here, of which we have got plant. Plant is worth 2.6 million, which is 2,600 in thousands. Then the plant is depreciating. So if the plant is depreciating, we should also have the excess depreciation. We are told the plant is depreciating. The plant has got a useful life of 3 years. But post acquisition it had got only 9 months, so we'll say the value of the plant divided by 3, we get the depreciation for the year, then we multiply by 9 divided by 12 to get the depreciation for 9 months. Let's continue with note number 2. We have got the contingent liability of 850 at acquisition, and it's also 850 at reporting, because we are given this note here that Silverco has not incorporated these fair value changes into its financial statement. So the fair value of the plant and also the fair value of the contingent were not posted on the financial statement of the subsidiary Silver. Then when doing the consolidated profit or loss, this will take into consideration this excess depreciation. Now let's go to working 3, which in this instance happens to be our requirement A. Working number 3, we will start with consideration. Consideration here we see what the parent paid to acquire its 90%. So we are told here that on 1 January 2020 X2, Goldco acquired 90% of the 16 million ordinary shares of Silverco. Gold issued 3 new shares in exchange for every 5 shares acquired in Silverco. So the first consideration is share exchange. So now we'll calculate how many shares were purchased is 90% multiplied by 16,000. We get the number of shares that were acquired. Then we exchanged out 3 is to 5. Then the share price of gold was 8. At acquisition, we are given this information here. Now let's calculate it there. We get that figure. We are also told additionally Gold will pay further consideration on 31 December 20X2 of 242. So here now we have got a deferred consideration. Deferred consideration for 1 year, because we acquired 1 January 20X2, the payment will be 31 December X2, that is 1 year. So we have to discount this payment that we will make in December to 1 January. So we'll call this one deferred payment or deferred consideration. It's 90% of 16,000. We get the number of shares that were acquired by Gold. Then we multiply by $2.42 per share that was promised to be paid, but this needs to be discounted because this payment is at 31 December 20X2, so we are given also the discount factor of 0.9091, like that. So say 90% multiplied by 16,000, we get the number of shares that were acquired. For each share we need to pay $2.42. Then we discount that to 1 January, we get that figure. Please note, when we make a deferred payment, we need to unwind the interest, unwind the discounting. Then now we can have our NCI. The NCI has got a remaining 10% of the shares. The shares are 16 million, like that. Then how do we value the NCI? We are told here under note number 3 that we should use the share price to value the NCI at fair value. So we use the share price like that. Let's say 10% multiplied by 16,000 multiplied by $3.50, like that. Then we need to subtract the net assets at acquisition. The net assets at acquisition, we didn't put the total there, so let's put the totals here. Sum at acquisition, so this is the figure that is coming here. Also sum at reporting. So now by this we can now calculate our goodwill. This is our goodwill. We have answered question A for 6 marks, but let's continue. Now we are on note number 4 for intra-group sales. Intra-group sales, as we need to reverse the intra-group sales when we are doing the consolidation. We are told here 600,000 per month, and the post-acquisition period is 9 months. So we'll say 600 multiplied by 9. I am working everything in thousands. We are also told that there is a closing inventory of 1.2 at a markup of 25%. So we need to remove the up on closing inventory. That also affects the cost of sales. So we'll say 1,200 for 1.2 multiplied by 25 divided by 125, like that. So we have to remove that PAP of 240. How do we remove that? We credit inventory as we are reducing the inventory and debit the cost of sales. That's what we'll do, add that figure to the cost of sales. Now let's go to note number 5. Note number 5, we are told that Goldco's investment income is a dividend received from its investment in a 40% owned associate which it has held for several years. Let's go and find that investment income. This investment income of 800. The dividends, they mustn't feature in any way in the consolidated financial statements, and also in the statement of profit or loss. The dividends received from the associate are used to calculate the associate figure in the statement of financial position, so they do not feature in the statement of profit or loss. So we'll remove that 800 and also put this profit of the associate. Let's say share of associate profit of associate profit. How much the associate made the profit of 3,000. Goldco owns 40% of that. So we say 3,000 multiplied by 40%, like that. So we'll give Goldco 1.2. Now let's go to note number 6. Note number 6 here, it's a convertible loan note or convertible bonds, but convertible loan notes. Now the convertible loan notes needs to be split between the liability component and the equity component. The equity component is also transferred to the statement of SFP as other components of equity, OCE. So the value of the this $100,000 convertible loan has to be split into its liability component and its equity component. So we have to do that. Doing that, we have to discount all the interest payments that are received and also discount the principal amount. So now here, if we say 100,000 times $100, we get 10 million. So if we get 10 million, then when we are working in thousand, that will be 10,000. Now we need to pay interest. The interest is always paid at nominal, so it's 6% at par. So the interest will be paid at 6%. So say 6% multiplied by 10,000. As we said, 10 million, and we are working in thousands. The interest payment will be 6% multiplied by 10,000. We get 600. There is the principal amount. Principal amount is 10,000. Then now we have to discount this. So the interest will be receiving interest for 5 years. So we have to discount using the annuity factor. Which annuity factor? We mustn't discount using this annuity factor of 6%. We should use the annuity factor of a non-convertible bond or non-convertible loan. So we discount at 8%. If I can write 8% here, always use the bigger percentage, which is the percentage of the non-convertible. So we discount that at 3.993. Then also that after 5 years we will receive our principal. We discount it at that location, at that discount factor. So we say interest multiplied by the discount factor. That's the figure that we get. We also copy the formula there. So we have discounted there. The figure that we will get here is the liability element. Now we need to get the equity component. So the principal is 10,000, then the equity component is 794. With your permission, let me do the amortization schedule. It was not needed in this requirement, but let me do the amortization table so that you get the concept. How the amortization table looks like. The amortization table, we will have the opening liability, then we will have the finance cost, then we have the interest payments, then we will have the closing figure that will go to the statement of financial position. Now the opening liability that we have is 9,206. Then the finance element, always the finance cost is the percentage of the non-convertible bond, but the 6% is the par value of the convertible bond, and the 6% we have already calculated the 6% interest is 600. So with your permission, I will have to run through 4 years, 5 years to to show you clearly how this works. So now we'll say this percentage, this amount opening multiplied by the interest element, then we get that figure. Let's just remove the fractions there, copy the formatting, also copy that formatting so that at least you will not have problems. Now the interest is a payment, so it needs to be in brackets. Let's copy again the formatting. Like that. Then the closing, we will say opening at interest less, at finance cost less interest paid. The closing will be 9342. This will be the figure of the liability that needs to be shown at the end of the year if we are doing the statement of financial position. But in this instance, we are not doing the statement of financial position. Now we'll simply say 9342 as our opening for the following year. Then we can also copy the formula down here so that at least it will work faster. Now our opening will be 9489. It's calculated there. Again, our opening will be 9648. Again, our opening will be 9820. So now we have come back to 10,000 with a slightly rounding of $6 there. So the finance costs, these are the finance costs that needs to be posted into the statement of profit or loss. But here we are told that the accountant posted the interest payment. We mustn't post the interest payment in the statement of profit or loss. We should post the finance costs, not the interest. So what we have to do, we have to go and reverse the interest, then post the finance cost. So we'll go and reverse 600 and post 736. That's what we are going to do. Now we are through with the notes. We are told here there was no goodwill impairment. Thank you. Then now we need to construct our statement of profit or loss. We have got revenue. Let's go back up here. Revenue for the parent, which is gold, is 103,360 plus. Take note of this ACCA trick. We mustn't put the 6,800 as revenue, as we only need 9 months worth of revenue. So we'll say plus 9 over 12 multiplied by 60800. We have to less the intra-group sales of 5,400, like that. So we'll say 103,360 for the parent plus 912 of 60800 less 5,400 less 5,400 as the what? As the intra-group sales. Let's copy the formatting here. Now let's come to cost of sales. Cost of sales for the parent is 81920 plus 9/12 of 41600 less intergroup sales. We have got another figure that needs to go to cost of sales. That's the PAP of 240 plus 240. Let's check depreciation. Depreciation is charged to cost of sales. So we need to add depreciation. Where did we get our depreciation? Our depreciation here, excess depreciation of 650 from the fair value. Then we are done here. We say $81,920 for the parent less 9/12 of 51,600. Then we subtract the intra-group sales. Then we add the PAP. We also add depreciation. We get that figure. Then we sum up to get our gross profit. We get our gross profit like that. From gross profit, we put distribution costs. Distribution costs will take all of the parent plus 9 divided by 12 of the subsidiary, 2980. No adjustments here. 2560. We add 9/12 of the subsidiary, which is 2980. Get that figure. Then administration, admin expenses. We've got for the parent 080. We add 9 over 12 of the subsidiary, 3740, like that. Then we will simply say 6060, we add 9/12 of 3740, like that. Then investment income, we said we are going to reverse this, but substitute with the share of associate profit. Share of associate profit, we have it up here as 1,200. Then finance cost. Finance costs, we have 672, but we said we are going to subtract the 600 and add the 736, the correct. We have to remove the incorrect interest and add the correct finance cost. Then from here, we also need to add the unwinding of this deferred payment. The unwinding of this deferred payment. So now let's pause from here and try to unwind this deferred payment. So we can put it here. I'll insert some few columns here. Unwinding of interest. So here we'll say the figure was what? 31,680. We need to multiply by 10%. Now we need to remember the 9/12 because we are not unwinding up to December, but we are unwinding up to 30 September. 10% there. We get that figure 2376 that we need to also add to the finance cost. Now our finance cost will be 672. We remove 600. We add 736. We also add 2376, like that. Then here we can sum up to get the profit before tax. Profit before tax. Then we can calculate our tax here. 4480 for the parent plus 9/12 multiplied by 2560, like that. 4480 9/12 multiplied by 2560. We get that. Then now we sum to get the profit for the year. That is the profit that we get for the year. Profit for the year. Now we need to split this profit to the parent and the NCI. The total will still remain as this. We need to split between the parent and the NCI. So how do we split the NCI? We take the profit for the year. This is what? 9920. We multiply by 9 divided by 12. We multiply 9 divided by 12. Then from this one we subtract the excess depreciation on the fair value of the plant. Then we multiply everything by 10%. The percentage of the NCI. So we say 9920 multiplied by 9 divided by 12 less 650, the excess depreciation, all multiplied by 10%. We get that figure. Then the difference becomes the parent, becomes profit attributable to the parent. This was what was required in question B here for 14 marks. 6 marks goodwill, 14 marks the consolidated statement of profit or loss. Please play this video time and again and practice. And also do not forget to subscribe to my channel if you have not done so. Thank you for watching.